Well, good afternoon, one and all. Thank you for joining us on our first webinar. I think we're just waiting for maybe a few extra people just to join us. So we're just going to leave it just for a minute or so, and then we'll get started. I wish I could say it's good to see you, but I can't actually see you. So I hope you can see me okay, and you can hopefully you can see the slides okay. My name is Peter Langridge, and I'm one of the tax managers at Simmons Gainsford. Today our seminar is likely to last probably around half an hour or so, and there should be a question section that you can actually tab into. So if you do have any questions, please do feel free just to type those in there. If we can't get to them during part of the presentation, then our contact details will be at the end of the slide, so hopefully then we can pick those up afterwards. I'm delighted to be joined today by my colleague Jamie Salvage from So Legal, who's a director and solicitor there, and he's also going to be providing you with the second sort of part of this this webinar. For my part, I'm just going to provide you with some bite-size sort of chunks of information based around some perhaps more recent income tax and capital gains tax elements, but please don't take any of this as a substitute for specific advice tailored for you. So we're going to crack on now, and let's just see. So yeah, before we start, just a little bit about Simmons Gainsford. We're a specialist chartered accountant and business advisors and management consultants. We've got offices in central London, Upfield and Gibraltar. Our services include business outsourcing, bookkeeping, credit management, financial services, insurance solutions and payroll. And essentially, we aim to be a one-stop shop for your financial requirements, so we can deal with things all under one roof effectively. Our mission primarily is to help our clients create and preserve their wealth through providing them with consistent quality advice. We service both business and private clients, from owner-managed businesses and SMEs to high net worth individuals and PLCs. And we also strive to ensure that our clients benefit from the personal attention and expert service that has become our hallmark. So, income tax and capital gains tax, bit of a dry subject, bit of a conversation stopper, some may say, but there's a few little themes that have been developing recently, and I'm going to be focusing just mainly today on owners of individual residential property who let those properties out. Not so much on the company side. There is a question that's coming about the company side, and I'll deal with that if that's okay on a follow-up subsequently. So let's start with income tax. Just a few of the basic things that have perhaps been missed, or perhaps people aren't as aware of as perhaps once was. There's a property trading allowance. So if you're letting out a property, there's an allowance of £1,000. And so if your expenses letting your property are less than that, it might just be worth considering claiming this allowance instead. Something else to note with the property trading allowance is that if your rental income is less than £1,000 in total, then this will effectively mean that you won't need to have a reporting requirement on that rental income. It's a useful little allowance if you don't have much in the way of rental income, or if your expenses are quite small. Just bear that one in mind. Hopefully you'll see a direction of travel where we're going to be going with this as the slides kind of progress. But this is just a reminder with the 10% wear and tear allowance. This was actually withdrawn back in 2016 and was previously available for people who had furnished residential property, and they could basically claim 10% of their gross rents generally as a deduction, as a wear and tear allowance. That's been withdrawn, and you'd be surprised at the number of people who are still trying to think, I can claim a wear and tear allowance, let's claim an extra expense for that. That's no longer the case. What has happened is that we are now working within a replacements sort of world, whereby if you're replacing an item on a like-for-like basis, then generally it can be considered as an expense for rental purposes. It's not necessarily across the board, and each expense does need to be looked at in isolation, as it were. But we need to bear in mind what is known as the wholly and exclusive rule. So if the expense is not wholly and exclusive in connection with the rental property, it's unlikely to be considered as an expense. And we do get asked about what kind of expenses can be claimed generally on a rental property. And these can vary, to be honest, from your general repairs to maintenance to insurance to agent's commission and loan interest, which we'll come on to. That's where one of the largest changes has happened recently. And if you're not sure, I always say speak to your accountant, speak to us, because some expenses you might think are capital in nature, but actually they could be regarded as revenue. Classic example would be replacement of windows. And so this day and age, we live in a world where most of the modern day equivalent is UPVC. But if you're replacing windows, they might actually be an old wooden equivalent, and maybe not so much to do with sash windows, because the modern day equivalent may be an exact replacement. But UPVC replacement double glazed windows on a rental property is generally allowable as an expense, so that's one to bear in mind as well. So just bear in mind, wholly and exclusive rule. For those who have rental income or perhaps a portfolio where your income is over £100,000 when combined with your other income, it's worth noting that your personal allowance will be withdrawn effectively. It's abated by £1 for every £2 over £100,000, and we'll see how that will actually pan out in an example shortly. And as I briefly mentioned, there are some mortgage interest restrictions as well. There's a question that's just come in. Sorry, I'm just diverting onto my screen. So one of the questions that's come in about is the property trading allowance per property. So if you had 5 buy-to-let properties, would that be 5,000? No, it's treated as one business, so it's just one allowance. Moving back then to what could happen as a result of what I'm about to say on mortgage interest restrictions, it could actually result in your gross income and taxable income going up as a result, which could bring into the scope things like the high income child benefit charge. So let's look at this mortgage interest restriction. So I'm going to bring all of these up for now. So this all started back in 2016-17, when effectively loan interest, generally speaking, could be expensed against gross rental income, therefore significantly or potentially significantly reducing your taxable income. Government, I think, decided that this was a little bit unfair because those that were perhaps a higher rate taxpayer would benefit from higher rate tax relief effectively on those expenses. And if you were a basic rate taxpayer, then that would have only been at 20%. So maybe that's one of the reasons why they brought this phased restriction in. And it started in 2017-18. And what was announced was that you could, at that point, have 75% of the loan interest as an expense, if you like, within the rental accounts. And the other 25% would be given effectively as a tax reducer at 20% at the end of the tax computation. And you can see the direction of travel here again. 2018-19, the loan interest deduction was limited to 50% of the amount of the loan interest, and the other 50% as a tax reducer at 20%. 19-20, the last tax year, only 25% of the loan interest cost could be included as a deduction, with the remaining 75% shown as a basic rate tax deduction. So one of the major changes where people might find this biting now is the 2021 tax year, this tax year, because all financing costs incurred by a landlord are now effectively only given as a basic rate tax deduction. This is a quick table. If you look at someone who might have been a 40% taxpayer in 2016-17 and had £10,000 worth of loan interest, they would have received £4,000 worth of loan tax relief effectively, whereby the 2021 tax year, it's now 2,000. Just look at an example just to see how this would work in practice. We've got an individual here with employment income of £30,000, gross rental income of £35,000. Just to keep it simple, no other rental expenses, just the loan interest, which for this example is £16,000. So just a basic example, there's the employment income, the taxable rental income in 16-17 this is £19,000, the 35,000 less the 16,000 loan interest, which leaves you with the total of gross income £49,000. Take your allowance off and you'll pay tax on £38,000, something like £8,800, something like that. If we now roll forward this example to the 2021 tax year, exactly the same scenario, £30,000 of employment income, no other rental expenses, just the interest, loan interest of £16,000. This time round, you'll see from the computation that there's employment income of £30,000, taxable rental income now of £35,000, noting that there is no immediate deduction from that gross rental income. Therefore means your total gross income is £65,000. So you're effectively now going to be paying tax on a much larger amount of £52,500. You can then therefore see in the actual calculation of the tax that the loan interest then comes into the computation effectively at the end and given as a tax reducer. So in this scenario, the tax due has become £10,300. You might think, okay, it's only gone up £1,500 in this particular example, but it's still showing an increase nonetheless. Perhaps another aim for the government, maybe to gain more finances. What's interesting about this example, though, is when you look at the total gross income, it's now £65,000. Nothing's really changed, of course, apart from the fact that if someone in this family claims child benefit, then this person is likely to encounter a high income child benefit charge as a result of the income going over £50,000. So you can see already that there are changes to the loan interest elements, and it can impact upon other taxes as well. So you just do need to bear that in mind. Let's take a second example, hopefully just to sort of demonstrate it with perhaps a slightly different twist. We've now got a rental income of £200,000. The loan interest is £180,000. We're just trying to keep this very sort of clear and simple. So at the moment, we've got in 16-17, we've got £20,000 worth of taxable income, personal allowance, taxable income of £9,000. There's about an £1,800 tax liability. It's not rocket science. Okay. We now roll forward exactly the same scenario. 2021. This time though, there's no deduction for the loan interest at this point, so the taxable income is £200,000. You'll note the personal allowance, which I mentioned a few slides ago, has now effectively been withdrawn because the income has gone way over £100,000. So that's already penalising an individual as a result of this. And once again, we then see the loan interest tax reducer coming in towards the end of the computation, and in this scenario, you'll see that the tax liability has increased substantially to £39,000. Massive increase, something to be aware of. It's going to catch quite a few people out going forward, so just be aware of those things. Moving on to capital gains tax, there's been a few changes that have occurred recently that are certainly going to impact you if you're thinking about selling a residential property from the 6th of April this year. But a few sort of things that have been going on in the background, the first of which is principal private residence relief and the last period of ownership being an exempt period. So this is a case where you lived in a property at some point during the period of ownership, you've established it as your main residence, and previously you were granted the last 3 years of ownership as an exempt period when it comes to selling the property effectively. So if you moved out of the property and it had been your main residence throughout, you've had effectively 3 years to sell it and not incur a charge to capital gains tax. That limit was dropped down to 18 months, which you think, okay, you can accept that. 3 years is quite a long time at the time. 18 months is probably okay, gives enough time to sell a property. But now, from the 6th of April, that last 18 months has come down to 9 months. And therein lies the dilemma, because is 9 months actually enough time to sell a property, especially given the current COVID climate we face ourselves with. So that's one to bear in mind in terms of the principal private residence. The last sort of 9 months are exempt, but if you had a property which you've been struggling to sell for some time, it could conceivably result in perhaps a small amount of capital gains tax becoming due. So it's just one to be aware of. The one category of people this doesn't affect are those who are moving into nursing homes, and the government have kept that at 36 months. There was also previously a valuable relief, a lettings relief, that was or could have been considered when calculating any potential capital gains tax liability, and this conceivably in past was worth up to £40,000 for an individual, depending on the circumstances. If you had again lived in a property at some stage and then you let it out and then sold the property at some point, you were granted this lettings relief. And if it was a jointly owned property, that could have potentially been up to £80,000, although there was a calculation to determine what the relief might be. But now, effectively, the way it has been changed, all but has removed the lettings relief capability. And the only time you can now effectively claim letting relief is if you've rented out a room in property which you are living in yourself. So to all intents and purposes, if you're thinking about lettings relief, it's pretty much a thing of the past. And now, and crucially, there is some additional tax reporting now within very specific timeframes regarding the disposal of residential property, which we're going to come on to now. So changes from the 6th of April 2020, again, I'm convinced this is going to catch many people out. If you have a property that you sell and it creates a gain on the residential property, you're now going to have to report it to the revenue within 30 days of completion using the revenue's new online service. This applies to all direct sales, transfers and gifts, and if there's tax due, that also must be paid within 30 days as well. So it's a massive change to how things would have been reported previously. If you had a capital gain on the sale of a property, you would have reported it within your tax return, and any tax due would have been paid following 31st of January. So now this significantly cuts down the amount of time not only in which you need to calculate what the likely position is, but also to pay any tax over to the revenue to avoid any interest and indeed penalties. Because the revenue have announced that they will kindly give penalties and interest to anyone who doesn't comply with this new arrangement. But what they have said, which is nice of them, really, is that it won't apply to those where there isn't actually a chargeable gain. So if I've had my property, I've lived in it throughout the period of ownership. If I sell it tomorrow, I won't actually need to report that because it's effectively exempt. There's double reporting because you still need to report this within your self-assessment tax return. Sometimes it might not be possible to calculate the exact amount of tax that may be due because it's dependent upon your other income as well in the year. So in those scenarios, it's the best estimate and then to reconcile things through the tax return. Now, in terms of these reporting windows, there is a small grandfathering arrangement, but it's coming to the end at 31st of July, so pretty much at the end of next week, where the revenue have said, provided if you've sold a property from the 6th of April, provided you get the declaration in before the 31st of July, they won't actually incur a late filing penalty. But that doesn't apply if there's tax due, and they will still charge interest. So if there's anything to take away from the tax side of things today, just bear in mind that if you're thinking of selling a residential property, you also need to be thinking about the fact that you need to report it within the new Revenues online service. You'll need a government gateway account to do that as well, and we can certainly assist you with that. But the reporting window is very narrow now, so if you're thinking of selling something, speak to an advisor before doing so that you can be fully appraised of what the situation might be going forward. Bear with me a moment. And the last thing to say on this is that the tax rates at the moment on property disposals are 18% and 28%, but of course there's an autumn budget coming up, and just last week the Chancellor announced a consultation process with the whole subject of capital gains tax. It's not surprising really with the costs that have been incurred with regards to the COVID-19 pandemic. There'll be a need to raise funds somehow, so don't be surprised if there are sweeping changes to capital gains tax. Whether they'll occur shortly after the autumn statement, I don't know, but I'd certainly keep that on the radar in terms of the rates of tax, if nothing else. I suspect they will probably look at what reliefs are available, so yeah, just bear that in mind. There is some regulatory information about us, which is, I'm sure you'll find that very interesting. So this is the point at which I'm going to thank you. If there's a couple of questions that have come in, but I would appreciate if maybe you could email me afterwards. I'll come back to you on an individual basis because there's a few variables that could change those. So if you can do that, but for now, what I'm going to do is I'm going to, technology willing, I'm going to hand you over to my colleague Jamie from So Legal, who's going to take over the remaining part of the presentation. So just bear with us for a few seconds, and we'll try and arrange that. Thank you for listening so far, and have a good day.
Good afternoon. Thank you, Peter, for handing over. Just a quick intro. I'm going to do a brief review of the residential market prior to the COVID-19 pandemic, what we've been seeing throughout the pandemic, and then also a little bit of what the future might hold moving forward. So just a brief outline for myself. I'm Jamie Salvage, Director of So Legal and co-founding partner of So Legal. We've been now running for 5 years. We're obviously a law firm. We've 5 offices across the southeast. There we go. So our head office is the Eastbourne branch of So Legal. We have a Brighton and Hove office, an Uckfield office, and a Notting Hill office. We also have our new office in Hastings that opened about 3 or 4 weeks ago, which seems to be up and running very nicely. We're a full service law firm. We specialise in property law, commercial and business law, construction and development, litigation, private client services, wills, probate and estate planning. You'll notice that we avoid doing what we call emotional law, so crime, family law, etc. I head up the residential property market, sorry, not the market, I head up the residential property team across the 5 offices. Sorry, just skipping back a slide. So our residential conveyancing team is across all 5 of our offices. We have a mixture of qualified solicitors, conveyancing executives, trainee solicitors, paralegals and support staff. We have extensive knowledge and experience of handling all property matters, including sales and purchases of freehold and leasehold property, remortgages, lease extensions, right to buy matters, buy-to-let transactions, limited company purchases, transfers of equity and equity release. So what makes us a little bit different as a law firm? We have invested in state-of-the-art market-leading case management system, which allows our lawyers to work remotely from any of our offices with their entire caseload at their fingertips. We offer an exceptional personal service, which you don't tend to find with kind of volume conveyancing law firms. We focus on efficiency, communication, and ensuring our clients get the best possible legal advice, of course. We're a technology-driven focused firm and sit at the forefront of legal technology development across the whole sector, which makes us a little bit different to some law firms out there. Just a brief overview of what I'll run through today. So a review of the residential market prior to 2020 and also early 2020, the effect of the COVID-19 pandemic on the market, changes and introduction of the stamp duty land tax holiday, and the likely impact of the changes in the property market moving forward. So just a bit of a review of where we were prior to the pandemic coming along. So from 2012 to 2019, there had been a year-on-year increase in house prices in the UK. In January 2020, RICS reported that new buyer inquiries were up 22% from November 2018. And it was widely predicted that house prices would remain a broadly flat national trend for the time being, i.e. no significant fluctuations in the house prices, either upwards or downwards throughout 2020. The graphic on the screen should kind of indicate where we've been since 2000 to January 2020. As you can see, kind of expected fluctuations in the market, particularly you'll notice the 2008 financial crisis and the crash and the number of inquiries dropping through the ground. That's a significant one. As you can see from the slide, it took approximately 2 years to recover back to very good numbers of prospective buyer inquiries in 2000 and end of 2009, beginning of 2010. As you can see, some ups and downs, peaks and troughs throughout the number of years following that, and to where we were in January 2020. As you can see, Pretty good numbers. Prospective buyers coming to the market, kind of where you'd expect to be really, with no predicted up and downs in the market at that given time. Interestingly, in the next slide, you'll see the significant drop through the ground in mid-March of prospective new buyer inquiries. Not unexpected, of course, but you might be surprised to see that it actually dropped below the financial crisis in 2008, significantly below that. But look at the stark recovery in early July. So it fell through the roof, and the recovery has been off the chart so far as prospective new buyer inquiries are concerned. So that's a lot to do with obviously the stamp duty holiday introduction, we think, but also a little bit of confidence in the market coming back pretty quickly. So a real stark change and a real up and down throughout that period. I've called this highlights of the mid-pandemic, so kind of what we were seeing mid-pandemic. So property matters put on hold and house prices falling. 4 out of 5 conveyancers reported an increase in clients pulling out of transactions, and a 94% reduction month on month of new instructions nationwide in April 2020. As we've just seen, that was a record low. So just to give you a kind of tangible flavour of the numbers, if a law firm was taking on 300 instructions per month in usual times, this was down to just 18 new cases, new buyer inquiries and new cases per month for that period of time. So a real significant drop off. And just to highlight that, house prices fell by minus 1.4% in June, according to Nationwide Building Society, the mortgage lender. A slightly smaller fall compared to May, which was minus 1.7%. This drags annual growth down into negative territory, with values at minus 0.1% lower than they were this time last year. This is the first fall on any annual basis since December 2012. So what have we noticed as a law firm? Well, not so many transactions falling through as such, but matters being placed on hold, kind of following government guidelines really in that respect. Some price renegotiations and reductions in line with predicted market falls, not to be unexpected, and a lean towards a simultaneous exchange of contracts and completion rather than the traditional exchange of contracts and a period between exchange of contracts and completion. That's really to avoid kind of instances where there were removal companies not working, or surveyors can't get out to the property. One of the clients being quarantined, so therefore effectively putting themselves in a position where they have to self-isolate and would be in breach of contracts through no fault of their own really, but not able to move. So a significant financial loss if they were unable to complete and the rest of the chain were able to complete. So lots of considerations having to be given to those things. But what we're generally seeing was there was a great deal of confidence in the local market still. So not so many, and a kind of bulk away from the a national trend, but transactions were not necessarily falling through, but they were put on hold. So the government response to this, so initially some confusion about what to do to get the property market going again, and then original advice to put things on hold, and then subsequently a call to action, so to speak, and to proceed with property deals. That was followed by the recent announcement on the 8th of July for the stamp duty land tax holiday, which would effectively exempt the first £500,000 of a property purchase from the tax. This means an estimated 90% of home sales will now be free from stamp duty, saving buyers up to £15,000. Critically, this will also apply to both second home purchases and buy-to-let investors. So just a bit of a review of where we were prior to the announcement in 2008. So the stamp duty land tax is applied for in one form or another for 325 years. So if you've bought a property, you'll be liable to stamp duty land tax. Whether or not you fall into a zero rated bracket or not, you still have to complete forms and advise HMRC that you've bought the property. So up to £125,000, you'll be paying 0% SDLT rate. The portion from £125,001 to £250,000 at 2%. The portion from £250,001 and to £925,000 at 5%. The portion from £925,001 to £1.5 million at 10%, and anything remaining after that on the portion above £1.5 million at 12%. And the holiday itself is introduced, so if you buy a property from the 8th of July 2020 until the 31st of March 2021, we're talking about completion, not exchange of contracts, not agreeing to buy the property, but if you've completed the matter in that time, then you'll now get relief up to £500,000 at 0%. The portion from £500,001 to £925,000 at 5%, and the proportion from £925,001 to £1.5 million at 10%, that follows the previous percentage rates, and likewise the portion from £1.5 million onwards remains at 12%. The stamp duty holiday gives a maximum amount that can be saved under the current regime to £15,000. The holiday rates, apply to first-time buyers and those who already own property. So no first-time buyer relief applies. It's simply that everyone benefits. Those buying additional properties are subject, though, to the additional 3%, the higher rate SDLT on those properties. The 3% also applies to those buying in the name of a limited company. So reaction and what the effects this might have on the property market, well, it remains to be seen a little bit, but it'll effectively mean in tangible terms that potential buyers will have to find less money up front for their purchase. This may or may not, and I've already seen it happen already so far in the past couple of weeks. It might mean that property prices are adjusted in the seller's favour over this period of time. So effectively, the seller will bulk up the purchase price a bit because they'll know that buyers have a bit more money in their pockets. Sometimes that has a bit of an effect. It remains to be seen whether that happens or not, but that's generally kind of what we've seen in the past with stamp duty changes in much the same way as this one. Controversially, no mention of backdating the new rates to those who completed during the pandemic. Rather frustratingly, I would have saved myself a bit of money if they'd waited on my own particular purchase, but we were not given any heads up that it might potentially happen, and most law firms have been kind of put in a position where they've had to react to it pretty quickly, and obviously the market has done so as well. Expectations, well, just to give a flavour of the last few months and where it might end up. So 48,000 transactions were recorded in May, 16% above the April figure. So already some confidence being retained there. Data for June shows a continued recovery in the market activity. According to the latest RICS survey for June, 71% of surveyors reported rising levels of new instructions and 80% saw rising new buyer inquiries. Prior to the SDLT announcement, or possibly with a strong suggestion that the announcement was going to be made and that the SDLT was going to be tweaked, data shows that the market has rebounded strongly, as we've kind of seen with the slides previously, with the first week of July seeing the numbers of sales agreed at 36% above the same time last year. The market's recovery will obviously be dependent on third-party issues and other things that affect the market, in particular lenders, and whether they tighten restrictions on or release restrictions on loan-to-values to limit the market availability. That may act as a bit of a drag on the market if they don't react pretty quickly. All kind of evidence that I've seen so far shows that they probably will. We've seen a return already of some 90% loan-to-value mortgages to the market, which were not readily available in the early parts of this year, and certainly with when the pandemic started. So full recovery obviously relies on consumer confidence and needs to improve from the historic low that we saw previously. As I've said previously, it will remain to be seen as to what will happen. I don't unfortunately have a crystal ball. I can tell you kind of where we are and what we're seeing from our end. I have some personal reservations myself about how busy the market will be between now and the end of March next year, and whether this will mean that we're just bouncing the depression further down the road come April 2021. But again, we'll see on that. Don't want to finish on a kind of that note. So on a brighter note, the market really seems good. The recovery seems good. You've seen from the slide the number of buyer inquiries has gone through the roof. We've never been busier as a firm in the past 4 weeks for new property matters, and I've seen quite a number of my buy-to-let investor clients coming back to the market, and I've not seen them for a couple of years, so that's been kind of a positive note. It's all looking positive, and the consumer confidence will have to be very good. Will have a very good chance of being restored over the coming 8 to 9 months. Just finally for me, I'm happy to have questions. We'll sit and wait for some questions to come in. If they come in, then great. If not, then please do feel free to email. Peter's contact details are on this last slide, as are mine. Nothing that I've said previously should be taken as legal advice, of course, but if you have any questions, I'm happy to help. We're a full service law firm. Thank you for your time this afternoon.